Russia's invasion of Ukraine has sent shockwaves around the world, exacerbating the stock market's troubles and frightening investors. The crisis has already resulted in dizzying rises in energy costs, which might have a serious impact on a variety of countries and businesses. Oil prices were already at their highest since 2014, and they have risen more since the invasion. Because Russia is the world's third largest producer of oil, greater price increases are unavoidable. Europe imports approximately 40% of its natural gas from Russia, and it will almost certainly face increased heating prices as a result. Natural gas reserves are depleting, and European officials are concerned that Moscow will cut off supplies in retaliation to the region's backing for Ukraine. Russia is the world's largest exporter of wheat, accounting for about a quarter of total global exports. Egypt, which is highly reliant on Russian wheat supplies, is already seeking new suppliers. The price of palladium, which is used in vehicle exhaust systems and mobile phones, has risen due to concerns that Russia, the world's largest exporter of metal, may be cut off from global markets. Nickel, another important Russian product, is also growing in price. Global banks are bracing for the effects of sanctions aimed at limiting Russia's access to international capital and limiting the capacity to process payments in dollars, euros, and other important trade currencies. Banks are also on high alert for Russian retaliation cyber attacks. The global oil market sell-off may provide some respite to Asia's policymakers. After all, this is not 1973. Prices nearly quadrupled in 3 months and then continued to rise. This time, Brent crude soared to almost $128 per barrel before plummeting drastically. Speculative bets for a further boom are unraveling as oil prices hover around $100 per barrel. However, authorities and investors should not be overconfident. Even if the benchmark does not reach the $200 level that commodities trader Pierre Aderon believes is likely this year, the oil may be a powerful instrument of stagflation. For openers, government budgets in Southeast Asia and India have anticipated an average oil price of $65 to $75 per barrel for the year. According to experts in Australia and New Zealand banking group, Malaysia and Indonesia, who are net energy exporters, will find it easier to subsidize pump prices. Net importers, on the other hand, may find it difficult to be as generous since they may need to cut back on development investment. Domestic demand is still below pre-pandemic levels, thus it seems reasonable to protect family consumption. However, the virus has also increased governmental debt, so consumers cannot be completely spared. According to ANZ, passing through a $40 per barrel boost to the local economy would have resulted in an increase in inflation ranging from 1.75 percentage points in Thailand to roughly 1.25 percentage points in the Philippines and India. However, a slight drop in global energy costs may not be enough to alleviate inflationary pressures. The cause for this is China. Traders are concerned about global oil demand as a result of China's recent Omicron epidemic. But the lockout in Shenzhen and Dongguan in Guangdong, which accounts for a quarter of the province's outbound trade, might potentially entail broader supply disruptions. According to a report by Singapore's Overseas Chinese Banking Corps, any prolonged or broader lockdowns in China would add further headaches, potentially resulting in the reduced production pipeline for factories elsewhere. As a result, rather than minimizing the inflationary issue, oil at $100 may wind up exacerbating it. Oil might harm Asia's growth prospects by reducing demand for the region's exports. History suggests that higher oil prices and the resulting increase in transportation costs do not bode well for trade flows. ANZ economists Sanjay Mathur and Crystal Tan write, a slowdown in global growth will also harm Indonesian and Malaysian non-energy exports. The OECD expects the Ukraine conflict to reduce global growth by 1% point this year. But because it also expects inflation to rise by 2.5%, it advises central banks to focus on countering price pressures. However, in Asia, such clear-cut institutional boundaries, governments supporting the expansion and monetary authorities dealing with inflation, were muddled by the pandemic, and the work of re-establishing them would most likely be postponed until after the war. Central banks may prioritize output by keeping interest rates low, while governments use energy subsidies to combat inflation. The results might be nasty for investors, especially since the U.S. Fed's tightening campaign is now in full swing. The West stagflation in the 1970s coincided with Asia's development. With the oil shock hurting their trade terms, South Korea and Thailand increased exports to compensate. Indonesia experienced a surge in investment. Conditions have changed as a result of the pandemic's scarring, among other reasons. Global investors are not fond of Thailand's bond market, while Sri Lanka requires assistance. Brent crude at $128 a barrel would have delivered a significant blow to Asia, but even $100 oil will not cheer it up. Brent crude oil momentarily surpassed $100 per barrel, its highest level since 2014, and European gas features surged following Russia's invasion of Ukraine. Russia's invasion of Ukraine pushed up energy prices, adding to concerns about limited supplies and generating new concerns about the flow of oil and gas from Russia into Europe in the coming months. Following the attack, Brent crude burst past the $100 per barrel barrier, soaring as much as 6% to more than $105 per barrel, its highest level in more than 7 years. The price of West Texas Intermediate crude momentarily surpassed $100 per barrel. However, oil prices began to stabilize, falling below $95 per barrel after President Biden stated that the U.S. was working with other countries to coordinate the flow of supplies from strategic petroleum reserves. Mr. Biden recognized that the Ukrainian invasion could result in higher gasoline prices in the United States. My administration is using every tool at its disposal to protect American families and businesses from the rising gas prices, taking active steps to reduce cost, he added. According to researchers, the supply of natural gas in Europe is more likely to be disrupted by the conflict in Ukraine than the flow of oil. On the TTF market in the Netherlands, the price of natural gas increased by over 19% to 105.6 euros per megawatt hour. According to Richard Brons, head of geopolitics at Energy Aspects, the scale of Russia's military activity ordered by President Vladimir V. Putin appeared to surprise some market participants and could explain the sharp increase in prices. As recently as yesterday, there was a mistaken view in the market that either Putin had gotten enough to pause or that things could be limited to Donbas, the disputed territory in eastern Ukraine, he said. The greatest concern for the energy markets, he says, is the Western sanctions that are likely to be implemented in response to the invasion. Despite promises from Western authorities to the contrary, there is concern that the financial sanctions will impair Russian oil and gas shipments. Mr. Braun stated that some importers were deferring purchases of Russian oil while they awaited the breadth of the restrictions. Analysts believe that in the long run, Moscow's aggressiveness against the neighbor, as well as the implicit threat to European and global energy supplies, would force Europe to strive harder to wean itself off its reliance on Russian oil, and in particular, natural gas imports. Russia provides more than one-third of the European Union's gas. Pipelines transport the fuel through Ukraine, albeit the volumes passing via such conduits have decreased in recent months. Europe is also a significant buyer of Russian oil. The war is taking place at a time when supplies of both oil and natural gas have been tight for months, driving up prices and creating a situation in which the prospects of disruption drives them even higher. In the case of oil, the crucial question is going to be whether sanctions hinder flows, because Russia produces 1 out of every 10 barrels of oil produced worldwide. Any conflict involving it is extremely concerning to oil dealers. If oil prices continue to climb, pressure will mount on countries such as Saudi Arabia and the United Arab Emirates, both of which are regarded to have room to expand output. That's it for today. Don't forget to like, share, and subscribe to our channel. If you like this video, I'm pretty sure you'll love the one that's showing up on your screen right now. See you there.